Joining us now is Gil Luria, a technology strategist with D.A. Davidson. Gil, good to see you.
Good to see you, Melissa.
And more specifically, Baba didn't even give an outlook. So there is no outlook to even think about when it comes to Baba. You know, these are stocks, Gil, that have been just bombed out over the past year plus. I mean, first it was the Beijing technology crackdown, and then you had the worries about delisting, and now you have the COVID lockdown, economic growth slowdown. What are you most concerned about at this point?
Well, all the above. Mostly that China is in a slowdown and the lockdowns are unpredictable and probably not ending anytime soon. Both of these companies have declining revenue right now. Their fourth quarter may have been flat, but as they talk about April and May, they actually have declining revenue. What we liked about these results and the market likes about these results is a conversation about deep cost cuts. In Alibaba's case, they make money in their China commerce business. They lose a lot of money in their other businesses. And so their willingness to cut down on costs, especially in those other ancillary businesses, is what we liked in the results today.
How do investors view the technology sector, Gil? I mean, when you're taking a look at the tech sector and you're seeing some of the pressure on big cap tech names here in the United States, investors are clearly questioning what their holdings are here. How does that translate when you take a, when they say, oh, I've got a tech allocation to make, maybe I'll put it in these names, which are already down, 55% on Baba over the past 12 months? Maybe that's for a trade, a better thing to do.
Well, I would say the preference needs to be to U.S. big tech. U.S. big tech may have concerns about some slowdown, some regulation, but in China, you're also adding these other concerns about lockdown impact, political concerns, and then in addition, the ability to possibly be delisted from the U.S. So unless you have a really inexpensive stock, which Alibaba, by the way, is, U.S. big tech looks better. Apple at 22 times earnings, Microsoft at 26 times earnings looks better to me than anything in China. Alibaba starts being interesting because they're trading at 9 times EBITDA, in spite of the fact that they lost 50 billion RMB on their ancillary businesses. If you take those out, they're cheaper than eBay. That's when it starts being interesting.
Do you think on the U.S. side that investors have discounted the worst case scenario for technology? I mean, as you take a look, your concern about the Chinese economy is the economic slowdown. Here in the United States, we're entering a rising interest rate period. There is a move away from long duration, and so therefore technology. And I'm wondering if you think we have factored in maybe a tightening that needs to still be done among U.S. tech companies, layoffs, budget cuts, et cetera.
Yeah, I think we've factored for a bad scenario in the U.S., not a really bad, not a real downside scenario, not an economic collapse. We're not expecting an economic collapse, though. The consumer is still mixed as opposed to all over weak. And so the companies in the U.S. have a little bit more visibility. By the way, we know how to get through a business cycle. In China, they've never gotten through a business cycle. The economy there is centrally managed. It was very investment-based. The consumer was supposed to pick up the slack there. But right now, the consumer in China is really suffering. Retail results are already declining in China almost across the board. And so I would argue that we have better visibility. That's why these companies, American big tech, are still guiding. The Chinese companies have very poor visibility. That's why Alibaba, for the first time as a public company, did not guide for its next fiscal year.
Right. I think that's an interesting point about a business cycle and not having lived through one on the Chinese side. Gil, great to see you. Thank you.
Thank you.